Imagine standing at the entrance of a vast library with shelves stretching endlessly in every direction. Each book represents a different piece of information about investing: charts, figures, news reports, expert opinions, and more. It's easy to feel overwhelmed, wondering how you could ever read and understand it all. That's how many people feel when they first start learning about investment markets. But here's the good news. You don't need to read every book on those shelves to be a successful investor. Just like in a library where a few well-chosen books can open up a world of knowledge, a few key investment statistics can guide your decisions and lead to long-term success. These statistics are often simple, sometimes even surprising, but they offer valuable insight that can shape the way you invest. Rather than getting lost in all the data, you can focus on these key principles and make smarter, more informed choices. It's like having a map to navigate the endless shelves of information. Let's take a look at a few of these essential statistics. They might just change the way you approach investing. Understanding investment markets can feel overwhelming at first because of the sheer amount of information available. However, you don't need to grasp every single concept or detail to become a successful investor. Instead, focusing on key principles and statistics can guide your decisions and improve your long-term success. Let's break it down. Start simple. Rather than trying to learn everything at once, focus on some basic, important investment statistics. These can serve as a foundation for making better choices. Long-term mindset. These key stats can help you make informed decisions that benefit you over the long run, not just in the short term. By concentrating on these fundamental ideas, you'll build confidence and skill as an investor. Let's dive into some of these essential statistics. 1. The S&P 500's annual return in a simple the power of investing in the stock market. Over the past century, the stock market has proven to be a reliable way to grow wealth. A key measure of this is the S&P 500 index, which represents 500 of the largest companies in the US and gives us a general sense of how the overall stock market performs. From April 1st, 1936 through March 31st, 2024, the S&P 500 has averaged an annual return of 10.755%. This means that on average, people who invested in this index saw their money grow by about 10.75% each year. What does a 10% annual return mean for you? If you invest in the S&P 500 and your money grows by 10% per year, compounding quarterly, meaning your gains are reinvested every 3 months, your investment will double in about 7 years. For example, if you put $20,000 into an S&P 500 fund today, in about 7 years, it could grow to $40,000, assuming the historical 10% return continues. Understanding the ups and downs. It's important to remember that the stock market is not predictable. Some years your portfolio might lose value, while other years it could grow by more than 10%. Despite these ups and downs, the market has historically averaged a solid return over the long term, which makes it a powerful tool for long-term wealth building. Key takeaway. While short-term swings can make the market seem volatile, long-term investors in the S&P 500 have typically earned strong returns. This average of 10% per year over many decades shows the importance of patience and staying invested, as the market tends to reward those who give their investments time to grow. By consistently investing in the stock market, especially in broad indexes like the S&P 500, you can grow your wealth significantly over time. 2. Understanding inflation. Why investing is key to protecting your money. What is inflation? Inflation happens when prices of goods and services go up over time. This means that the same amount of money buys fewer things than it used to. For example, if something cost $100 last year and inflation is 3.8%, it would cost $103.80 this year. Why does this matter? If you're not earning at least the rate of inflation on your money, you're actually losing purchasing power. Let's say you leave $1,000 in a bank account. Even if that amount stays the same, it won't buy the same amount of goods next year because prices will have increased due to inflation. On average, from 1960 to 2022, inflation in the US has been around 3.8% per year. So if you're not earning at least that much on your savings, you're essentially losing value. How can investing help? One way to protect your money from losing value due to inflation is to invest it. Over time, certain investments, like stocks, have historically earned more than the rate of inflation. For example, if your investments are growing at 6% per year and inflation is at 3.8%, you're still coming out ahead by 2.2%. By investing in stocks and stock funds, your money can grow at a rate that keeps up with or even beats inflation. This way, you maintain your purchasing power and don't lose out as prices rise. Key takeaway. To protect your money from losing value over time, it's important to earn at least the inflation rate, which has historically been around 3.8% per year. Investing, especially in stocks, can help you achieve this and maintain or grow your purchasing power. 3. Understanding why most day traders lose money and how index funds can be a smarter option. 1. Day trading versus index funds. Index funds. These are funds that aim to match the overall performance of a major stock market index, like the S&P 500. By investing in an index fund, you are essentially owning small pieces of all the companies in that index, allowing you to benefit from the overall growth of the market. Day trading. This involves buying and selling individual stocks in a short period, sometimes within the same day. The goal of day trading is to make quick profits based on short-term price movements. 2. Why do so many day traders lose money? High failure rate. Studies show that 80% of day traders lose money on their trades. In fact, 75% of those who try it professionally quit within 2 years because it is so hard to make consistent profits. Short-term gains and taxes. When you trade frequently, you're more likely to earn short-term capital gains. These are taxed at higher ordinary income rates, which means that even when day traders do make money, a larger portion goes to taxes compared to long-term investors. Fees. Day traders often have to pay a lot in transaction fees, which adds up and eats into their profits. 3. Day trading is extremely competitive. As a day trader, you're competing against some of the best professional investors on Wall Street. Many of these investors have access to teams of analysts, advanced tools, and years of experience. This makes it even harder for individual traders to succeed. 4. A better option for most people: index funds and ETFs. For most regular investors, it's better to invest in mutual funds or exchange-traded funds, ETFs, that aim to match the market. These investments might not be as exciting as day trading, but they are less risky and more likely to provide long-term consistent gains. Over time, these types of investments tend to grow with the overall market, and you don't have to worry about losing money on frequent trades, high taxes, or competition from Wall Street pros. In summary, while day trading might sound exciting, it's very hard to make consistent profits. 80% of day traders lose money, and most give up after 2 years. For most people, investing in index funds or ETFs, which aim to match the market's performance, is a smarter and more reliable way to grow wealth over the long term. Number 4, understand the cost differences between an index fund and an actively managed fund. What is an index fund? An index fund is a type of investment fund designed to mimic the performance of a specific group of stocks in the market, called an index. For example, the S&P 500 tracks the 500 largest companies listed on US stock exchanges. The NASDAQ 100 tracks 100 of the largest non-financial companies listed on the NASDAQ exchange. Index funds are designed to track, not outperform, these groups of stocks. This approach allows them to keep costs very low. They don't need to hire experts to research which stocks to buy because they are simply following an established group of companies. What is an actively managed fund? An actively managed fund, on the other hand, employs fund managers and analysts who try to pick stocks they believe will outperform the market. These professionals use research, analysis, and market trends to actively buy and sell stocks in hopes of getting better returns than the market index. Comparing costs. Index funds versus active funds. The main difference between these two types of funds is the cost. Here's a comparison. Index funds charge an average fee of 0.12% per year. On a $1 million portfolio, that's about $1,200 per year. Actively managed funds charge a much higher fee of 0.60% per year. For the same $1 million portfolio, that's $6,000 per year. Why are index funds cheaper? The reason index funds cost less is simple. They don't need to pay for a team of experts to pick stocks. They just follow the index, which is cheaper to manage. Are higher costs worth it? Although actively managed funds charge more, they don't always deliver better returns. In fact, 79% of active funds underperformed the S&P 500 in 2021. That means most investors paid more for an active fund, but didn't get better results than they would have by simply investing in a cheaper index fund, like one that tracks the S&P 500. Conclusion: when deciding between an index fund and an actively managed fund, it's important to consider both the cost and the potential returns. While actively managed funds aim to outperform the market, they often don't, and their higher fees can eat into your profits. For many investors, an index fund provides a lower cost option that often performs just as well, if not better, than active funds. Five, understanding bear and bull markets, a simplified guide. What is a bear market? A bear market is when the stock market is experiencing a decline in value. In simple terms, it means that stock prices are falling and people might be losing money on their investments. Average length of a bear market. Historically, the average length of a bear market is around 14 months. This means that on average, when the stock market is going down, it continues to decline for a little over a year before it starts to recover. What is a bull market? A bull market, on the other hand, is the opposite of a bear market. It's when stock prices are rising and investors are making money. The good news: bull markets last longer. On average, a bull market lasts about 5 years. This means that while bear markets, periods of loss, are shorter, bull markets, periods of gain, tend to last much longer. Key point: market cycles. The stock market works in cycles, meaning it goes through periods of gains, bull markets, and losses, bear markets. While it's not fun to lose money during a bear market, it's important to remember that the market will eventually recover. Historically, the positive bull periods last longer than the negative bear ones. What you should do when you invest, keep in mind that there will be ups and downs. Don't panic when the market goes down. Remember that over time, the market tends to grow, and patience can help you benefit from the longer bull markets. Six, the cost of missing the best days in the market. How skipping 20 days can turn profits into losses. Lesson: how missing key investing days can hurt your portfolio. 1. The temptation to cash out during a market crash. Imagine the stock market is falling. You might feel like cashing out your investments to avoid losing more money. It seems like a smart move, right? After all, no one likes watching their portfolio shrink. Why is this a mistake? Because many of the stock market's biggest gains often happen on just a few days, and these gains can come when you least expect them. 2. The importance of single-day gains. Sometimes the stock market jumps dramatically in a single day, rising by 5%, 7%, or even 10%. These are known as best investing days. They are unpredictable and often happen right after a market downturn when things are starting to improve. Why does this matter? If you're out of the market when these big days happen, you miss out on the chance to recover and grow your investments. The market doesn't just grow steadily every day, it tends to make significant gains all at once, especially during rebounds after downturns. 3. What happens if you miss these days? A study by JP Morgan found that from January 1999 to December 2018, a span of 20 years, if investors missed just the 10 best investing days, their returns were cut in half. If they missed the 20 best days, they wouldn't just have smaller returns, they would have negative returns. In other words, they would have lost money over 2 decades. The key takeaway: a few days can make a huge difference over the long run. 4. The danger of trying to time the market. Many investors try to time the market by guessing when the market will drop or rise. They sell during a crash, hoping to buy back in when things look better. However, because no one can predict the exact timing of these best days, this strategy often backfires. Investors who sit on the sidelines waiting for the right moment often miss these critical days. 5. Why staying invested pays off. The stock market is unpredictable, but it tends to go up over the long term. To take full advantage of its growth, the best strategy is to stay invested even during downturns. This way, you won't miss those key days of growth that can make a big difference in your portfolio. Summary: the market's biggest gains often happen over just a few days. Missing even a handful of those days can drastically reduce your portfolio's returns or even cause losses. The best strategy for most investors is to stay invested for the long term rather than trying to time the market. By keeping your investments in the market, you increase your chances of benefiting from these unpredictable but crucial days. Seven, understanding the importance of starting early, the path to $1 million. When it comes to investing, time is one of your greatest allies. The earlier you begin, the more time your money has to grow and multiply, thanks to the power of compound interest. This makes it significantly easier to reach your long-term financial goals. Let's walk through a real example. Imagine you have a goal of saving $1 million for retirement by the time you're 67 years old. You expect to earn a 7% annual return, which is reasonable for a portfolio made up of both stocks and bonds. Now, here's where timing makes a big difference. If you start at age 25, you only need to save about $350 per month to hit that $1 million target by age 67. If you wait until age 45, that same $1 million goal will require you to save around $1,650 per month, a much larger amount because you have less time for your money to grow. Why starting early matters? The reason for this gap is due to compound interest. When you invest, your money earns returns, and then those returns start earning their own returns. Over time, this snowball effect can have a huge impact on the growth of your savings. The more years you give your investments to grow, the less you need to contribute out of pocket. What if you're starting later? If you're still early in your career, take advantage of this by saving and investing as much as you can, even if it feels like a small amount. Every little bit helps in the long run. But if you're getting started later, say in your 40s, don't get discouraged. While you may need to save more each month to reach your goal, anything you can contribute now will still make a significant difference. As the old saying goes, the best time to start was yesterday, but the second best time is today. So, start now, no matter where you are in your journey. Takeaway: starting early allows your investments more time to grow, making it easier to reach large financial goals like $1 million for retirement. If you start young, a relatively small monthly investment, e.g. $350 at age 25, can get you to $1 million. Starting later requires a larger monthly contribution, e.g. $1,650 at age 45, but it's never too late to begin building your retirement nest egg. Remember, it's not just about how much you invest, but how soon you start. 8. Understand workplace retirement plans and why they matter. What is a workplace retirement plan? A workplace retirement plan, like a 401k, is a special type of account offered by your employer that helps you save money for retirement. One of the best things about it is that you don't have to pay taxes on the money you earn from your investments inside this account until you take it out in retirement. This means your money can grow faster because the taxes are delayed. Why is it helpful? Tax benefits. When you put money into a traditional 401k, the amount you contribute is taken out of your paycheck before taxes. This lowers your taxable income, meaning you pay less in taxes now. Plus, the growth on your investments is not taxed until you withdraw it in the future. Employer contribution. Many employers match a portion of what you contribute to your 401k. It's like getting free money added to your account, which helps your retirement savings grow even faster. The current reality: 44% have access to a plan. Only 44% of American workers are lucky enough to have access to a workplace retirement plan. If you're one of them, take some time to learn how your plan works so you can get the most out of it. Make sure you understand how much you should contribute and if your employer matches your contributions. What about the rest? 56% do not have a plan. Unfortunately, 56% of workers don't have access to a retirement plan through their job. But don't worry if you fall into this group. You still have options. You can consider opening an individual retirement account, IRA. It's a similar way to save for your retirement and offers some of the same tax benefits. By understanding the options available to you, whether through your employer or an IRA, you can take control of your retirement savings. Nine, understanding life expectancy and the importance of saving for retirement. Understanding life expectancy and retirement. When people think about investing, one of the main reasons is to prepare for retirement. But here's something that surprises many: retirement can last longer than expected. Life expectancy at age 65. According to the Social Security Administration, a man who turns 65 today is expected to live until around age 82. A woman turning 65 is expected to live until about age 85. What does this mean for retirement? Think about it. If you retire at 65 and live until 82 or 85, that's almost 20 years of retirement, and that's just the average. Many people will live even longer, reaching their 90s, 100s, or even beyond. Why saving is so important: because retirement can last a long time. You need to make sure you have enough money to live comfortably. That's where saving and investing come in. The earlier and more regularly you save, the more money you'll have to support your lifestyle in retirement, even if you live longer than expected. In summary, retirement could last 20 plus years. Saving and investing regularly can help ensure you have enough money to enjoy those years. Ten, breaking down retirement savings by generation. How does your 401k compare? Understanding 401k balances across generations. Fidelity recently provided data on the average 401k balances of their customers based on age group. Here's what they found. Gen Z, born 1997 to 2012, average 401k balance is $19,800. Millennials, born 1981-1996, average balance is $54. Gen X, born 1965 to 1980, average balance is $165,000. Baby boomers, born 1946 to 1964, average balance is $230. These numbers reflect money saved in 401k accounts, but people may also have additional savings in other investment vehicles such as an IRA, individual retirement account, or brokerage accounts. Key takeaways. 1. Comparison isn't everything. While these numbers give you an idea of how your savings compare to others, it's important to remember that everyone's situation is unique. Don't feel discouraged if your balance is lower than these averages. The important thing is to start saving and continue contributing consistently. 2. Most people don't retire with $1 million. A common recommendation is to aim for a $1 million retirement fund. However, these statistics show that many people don't reach that level of savings before retirement. That doesn't mean they can't have a comfortable retirement. Financial security depends on factors like your lifestyle, expenses, and sources of income in retirement. 3. The power of investing. These figures highlight the importance of starting early and investing wisely. The more time your money has to grow, the bigger your balance can become. Compounding interest means the money you invest now grows over time, so the earlier you start, the better. Next steps. Set goals. Whether you're just starting or well into your career, it's important to set a retirement savings goal. This will help you stay focused and motivated. Consider professional advice. Meeting with a financial advisor can be helpful. They can help you review your investments and create a plan that aligns with your financial goals. Remember, everyone's financial journey is different, and starting now is always better than waiting. Each contribution you make, no matter how small, brings you closer to a secure retirement.